Every major financial collapse of the last century has followed the same invisible roadmap. Not a similar one, not a rough approximation, the exact same sequence of events. The Great Crash of 1929 followed it. Black Monday in 1987 followed it. The dot-com collapse in 2000 followed it. The global financial crisis of 2008 followed it too. What changes is not the pattern, only the excuses. This sequence doesn't announce itself with sirens or headlines. It unfolds quietly, sometimes over years, while markets appear strong and confidence looks justified. Wall Street understands it. Central banks understand it. The institutions that manage wealth for the ultra-rich understand it very well. But most ordinary people never hear about it, because if they did, they would act too early, not too late. Today, I want to walk you through this 5-stage pattern, the same framework that warned of the 1929 collapse weeks before it happened, and show you exactly where we are right now. And the truth is unsettling. We are further along than most people realize. In September 1929, a businessman named Roger Babson stood at a conference and delivered a simple warning. Sooner or later, a crash is coming, and it may be terrific. The crowd laughed. Newspapers ridiculed him. The most famous economist of the era publicly dismissed him, insisting that stock prices had reached a permanently high plateau. 47 days later, the market collapsed. Babson survived and prospered. His critics were ruined. Babson wasn't lucky. He wasn't guessing. He was following a system, one built around 5 warning stages that appear before every major crash. Let's examine them. Stage 1, the credit explosion. Every collapse begins with debt, not panic. Before markets fall, credit always expands faster than the real economy can support. Borrowing becomes easy, leverage feels harmless, asset prices rise, making people feel wealthier, which encourages even more borrowing. What looks like prosperity is actually a tightening loop. In the late 1920s, Americans were buying stocks with just 10% down, borrowing the rest. Margin debt grew so large it matched the entire federal budget. Ordinary workers were leveraged like professional speculators. In 2008, it was housing debt, hidden behind complex securities and misleading ratings. In 2000, it was corporate borrowing by companies with no profits and unlimited optimism. Today, the scale is larger than ever. Official margin debt is massive, but that figure hides far more leverage. Wealthy investors borrow against portfolios. Options markets amplify exposure with minimal capital. Corporations take on trillions in debt to buy back stock instead of building resilience. Government debt has crossed levels once thought impossible. Measured against GDP, total debt in the system now is higher than it was in 1929 or 2008. Stage 1 isn't emerging, it's fully entrenched. Stage 2 is the concentration trap. Crashes don't happen just because prices are high. They happen because risk becomes concentrated. When too much market value rests on too few assets, stability becomes fragile. One crack can pull the entire structure down. In 1929, a handful of glamour stocks dominated the market. When they fell, everything followed. In 2000, tech giants carried the index. In 2008, risk was concentrated inside a few massive banks. Today, concentration is more extreme than ever. A small group of mega-cap technology stocks now represent an unprecedented share of total market value. Millions of people believe they are diversified because they own index funds, but in reality, they are making the same bet again and again. Passive investing intensifies this risk. New money flows automatically into the largest companies, pushing prices higher, reinforcing dominance, and increasing fragility. On the way up, it feels efficient. On the way down, it becomes mechanical destruction. Stage 2 is locked in. Stage 3 is the quiet exit of smart money. This is the stage no one likes to talk about. Before every major crash, insiders reduce exposure quietly. Executives sell shares, institutions hedge, wealth moves into cash and defensive positions. Public messaging stays optimistic, but behavior changes. In 1929, elite families exited months before the collapse. In 2007, hedge funds shorted housing while telling clients everything was fine. Executives sold personal stock while praising their companies publicly. Today, insider selling is at historic extremes. Corporate leaders, the people with the best internal information, are cashing out. At the same time, retail investors are pouring money into markets through retirement accounts, apps, and index funds. This is not coincidence, it is structure. Stage 3 is active. Stage 4 is the liquidity illusion. This is the most deceptive phase because nothing appears wrong. Markets remain calm, prices stay elevated, volatility seems manageable. But underneath, liquidity, the oxygen of financial systems, is being drained. When liquidity disappears, markets don't decline gradually, they gap violently. Buyers vanish, feedback loops take over. In 1929, rate hikes quietly drained liquidity. In 2008, tightening credit conditions did the same. In both cases, markets ignored the danger until it was too late. Today, central banks have tightened faster than at any time in decades. Trillions have been removed from the system, and yet markets sit near record highs. The stress is already visible: sudden bank failures, emergency interventions, fragile bond markets. These are not anomalies, they are symptoms. Stage 4 is unfolding now. Stage 5, the trigger. The final stage cannot be predicted, and that's what makes it dangerous. The trigger doesn't cause the crash, it reveals it. By the time the trigger appears, the system is already unstable. In 1929, it was a relatively obscure financial scandal overseas. In 2008, it was Lehman Brothers. Neither created the collapse, they merely ignited it. The next trigger could be geopolitical, financial, political, or something no one is watching. History shows it is rarely the obvious threat. What matters is timing. When stages 1 through 4 align, the trigger usually follows within 1 to 2 years. That places the danger window squarely in 2025-2026. The real lesson: this isn't about fear, it's about pattern recognition. The people destroyed in crashes are not foolish, they are unprepared. They trust stability because it has lasted long enough to feel permanent. They believe someone will warn them in time. History shows that warning never comes. Roger Babson survived because he respected the signals and positioned himself accordingly. You now see the same pattern. What you do with that knowledge is your choice. Markets may rise longer. Timing is impossible, but pretending the signals don't exist has never ended well. History doesn't repeat itself, but when human behavior stays the same, it doesn't need to.